How does the focus on further restrictions to daily life across Europe, how does that interact with your equity strategy at this point? Because obviously we have the playbook from March and April to look at, but the restrictions might be very different here. So what are you looking for as we go through the winter?
Well, as everybody has said, it's going to be a tough winter, and obviously infection rates unhelpfully have increased quite sharply right across Europe, and we're seeing a series of reinstatements of some kind of local restrictions and lockdowns, but I don't think a return to full lockdown is that likely. And we should bear in mind that we are in a recovery from one of the deepest recessions in history. And we think that recovery is going to be quite strong next year, supported by very aggressive policy easing. So across the Eurozone, we'd be looking at over 6.5% GDP growth through the year, and around 6%, 6.5% globally. So I think that with that prospect, and indeed with the probability in our view that there will be some vaccine approval by early next year, we would see the backdrop being quite positive for equity markets.
Do you see a continued gain for the kind of stocks that were up in March, April, May? I mean, the big tech, the work from home, the shop online stocks, and continued pain for, airlines, travel and leisure, bars and restaurants, etc.?
No, I think we're about to see quite a big rotation of leadership, and we just put out a note on that called Time for Value. We've been very strongly of the view that quality growth would be the dominant theme for a very long time, given weak global growth, low inflation and historically low rates, and the huge success of technology. But I think we're starting to get close to the conditions, a sort of constellation of factors which are normally consistent with some kind of rotation of leadership to more cyclical and value plays. Firstly, we do think that global growth is going to pick up more quickly, in fact, than the consensus. Alongside that, we would expect to see rising bond yields. And over the last 12 years, every rotation we've seen into cyclicals and value have been accompanied by rising bond yields. So that's going to be an important factor. Obviously, if we do get a vaccine, that will boost optimism as well. And alongside that, we're pretty bullish of commodity prices through the course of next year. So I think at least for a tactical opportunity, investors should be looking a little bit more at some of these really beaten up cyclical and particular value parts of the market. It doesn't mean that long-term secular trends will change, but I think a rotation of leadership is quite likely.
Yeah, let me ask you a bit more about that then, Peter, because this is very much a sort of short-term technical phenomenon that you're talking about here. And you point out in your notes there have been 15 occasions during which you've seen this temporary rotation into cyclicals and out of defensive since the GFC, the financial crisis. They last on average 4 months. So how do you get the timing right for that, given we're about to head to the US election as well, which could throw other comparisons off kilter a little?
Yeah, you're right. The history, at least since the financial crisis, has been a very long secular outperformance of growth and defensive growth, low volatility. But there have been rotations. Those rotations have been short-lived because the rises in bond yields, which they were associated with, were also very short-lived. And we continued to see further downward movements in bond yields very quickly afterwards. That's probably going to be the most likely trigger. But remember, we are moving into a different phase here. The last decade or so was one of very, very accommodative monetary policy, but generally tightening fiscal policy. We're now in a phase where monetary policy is even easier. We've got negative real rates, which is positive for risk, but we also have these very big fiscal boosts. And in the event of a blue wave in the US, if that happens, a much bigger fiscal boost again in the first half of next year. That probably will push bond yields up from these historically low levels. And that's what I would be looking for to generate some leadership in more of the cyclical and value parts of the market.